Welcome, everyone. We're so excited to have you join us today. My name is Jelena Ogilvie. I'm a partner and wealth advisor here at Principal Wealth Partners. For those of you that are just getting to know us, we're an independent, fee-only financial services firm in Connecticut. We're in 3 locations: Madison, Old Saybrook, and Westport, where I am today. Our mission is to help our clients achieve their desired outcomes. And we do that by guiding them through the financial goals in their lives. We are extremely proud that our founder, Bob Pialucci, was recently named by Forbes as a best in class for the state of Connecticut. And then more recently, last weekend, was ranked by Barron's as a top advisor in the country as well. So a little bit about myself. I have been in the industry for 23 years. I have my certified private wealth advisor designation, which focuses on financial planning, and also my certified investment management analyst designation, which focuses on portfolio construction. I'm going to hand it over to my 2 colleagues to introduce themselves as well.
Hi, everybody. Happy late afternoon. I am John Hannigan. I am also one of the wealth advisors here. I'm in Westport today as well. And I am also the Director of Financial Planning for Principal Wealth Partners. From a designation perspective, I'm a CFP, or a Certified Financial Planner, and I have been one since 1994. And just to give you an idea as to how long ago that was, my mom, bless her soul, had to drive me to the test site because I was very young then. And I was unlicensed from a automobile perspective. That's how long ago it was. You know, you try these jokes and in rehearsal, they work great. And then you just never know how they're going to go. Anyway, I'm going to throw it over to my associate, Meg Maruso. Meg, what's happening with you?
Hey, John, thanks very much. We're delighted that all of you joined us today. Just to give you a quick background on me, I started my career out of college in customer service. And from there, I've been in financial services for also about 23 years. By combining the experience from these 2 positions, it helps me in my role as a relationship manager at Principal. While I spent some time at Prudential, I did investments in financial planning there, as well as developed a background in life, long-term care, property casualty, and annuity products. Part of our philosophy here at Principal is we work in teams. So Jelena and I will co-advise on an account, or I'll work with John or one of the other advisors. The co-advisor model that we use allows our clients to benefit from what you just heard, our various subject matter expertise that we have throughout the firm. So I'm going to turn it back over to Jelena, and she's going to review our agenda for the call.
Great. Thanks, Megan. So yes, the topic today, COVID confirms the financial fundamentals. To describe last year as unprecedented would be an understatement. In fact, that was the word of the year, according to dictionary.com. We had such an emotional roller coaster with the pandemic, social unrest, and then the election. And then to think of what happened from a market perspective, I'll just highlight a few things, but we had very quickly into the pandemic, the largest quarterly drop in the economy that we've ever seen, very quickly followed by the fastest drawdown into a bear market. And a bear market is when the market drops by more than 20%. We dropped 34%. And then on top of all of that, you have the central banks around the world still ballooning their balance sheets to a point where we've created the lowest bond yields that we've ever seen in history. So the goal today is, with all of this abnormality, I guess I'll call it, we want to confirm that the financial fundamentals still apply when you think of your long-term strategies in investing. So we're going to talk about the importance of an emergency fund. We're going to talk about portfolio diversification. What is it and what's the benefit? How do we manage our emotions? I think this is the toughest piece of the equation. We're going to evaluate your risk tolerance. And then finally, we're going to talk about investing for the long term. And we're going to ask you to think of these fundamentals as a layer of a cake. And we're going to start building on those. And you'll hear that as we go through the presentation today. And then finally, we're going to talk about where we are on this economic recovery and what we might see from a market standpoint from there. So to start the discussion, I'm going to hand this back over to Megan.
Thanks, Julina. Okay, let's move on to our first topic Julina mentioned, which is the importance of an adequate emergency fund. We talk about establishing an emergency fund. It seems like an easy concept. We all understand it, but it was one of the biggest, if not the biggest lesson that was learned by a lot of people during COVID. Why is an emergency fund important? We feel it's critical if you lose your job, you could become disabled or ill, or you just have some type of an unexpected event. And what the idea behind a properly funded emergency fund is it allows you to cover at a minimum what it costs you to live monthly. And you want to be able to cover it from liquid funds, so you're not tapping into your retirement or any of the long-term savings that you might be doing. What is not an emergency? It's also very important to keep that in mind. An emergency is defined as something that's unexpected that can't be avoided. So it's Sunday night, you're watching TV, you've been in the house for 12 months, and now you're starting to see commercials to go to Aruba. This is where you need to remind yourself that something you want to do or purchase does not justify breaking into that emergency fund. And it's hard sometimes, it's very tempting. So what are some of the benefits you get when you have an emergency fund? It helps you prevent creating or adding to some debt that you may already have. It's especially important if you have a one-income family or you're a single person. You should make building the emergency fund the top priority and the first step in planning your future financials. It's very important to self-employed or independent contractors who may have a seasonal type business that has slow months. So you're a landscaper and then there's no snow, so you're not snow plowing. You can have some pretty tough times throughout that winter, and that emergency fund will come in handy. Homeowners use it all the time for unexpected repairs. Your furnace breaks in February. It's tough to say, hey, okay, let's put $500 a month aside for the next 8 months, and meantime, we'll freeze to death. So you need to have that emergency fund. And again, it'll protect your savings so you're not tapping into a retirement fund that will also cost you on the tax side.
So Megan, a common question that we get is how much should I have in an emergency fund?
Actually, that's a great question. Thanks for bringing that up. First step is get a handle on what your monthly expenses are. You'll hear a lot from talking heads, or you'll read in articles. The recommendation is 3 to 6 months. But we recommend, and especially after what we saw people go through with COVID, we would suggest 12 months worth of your essential monthly expenses, especially if you only have one income. A lot of people now have moved on to a high deductible health insurance plan, which sounds great when the premiums are low, right up until you need to use it and meet that deductible. If you have a growing family or substantial debt, those things are all going to impact it. So 12 months is what we recommend. We also just want to reinforce it should be in something liquid, a regular savings account, or perhaps like a prime money market. So we've established why it's important to have your emergency fund. And a lot of what we do at Principal, which Julina alluded to, is we build one financial concept and then layer another one on top of it. So we just talked about the emergency fund. Let's move on to the next layer, which is the benefit of diversification. Diversification is another critical piece when you're setting up your financial portfolio. What it does is it utilizes asset allocation to distribute your investments among various sectors, asset classes, industries, and risk categories. Let's take a look at the chart that John has up. This is a great illustration of how an asset class you'll hear about is on top of the world one year and then swings completely the other way. Take a look, if you would, at that pale purple box at the top of the year 2017. It's marked emerging markets equity. In 2017, that was the darling king of the hill. And then at the at the bottom of the pile in 2018 and you would have hated it. So the asset allocation portfolio is the little white boxes that are tracking in about the middle of the page. And what that portfolio equates to is about 60% in stock and 40% in a fixed income product. And that's really a mix of all the colors that you're seeing on the chart. That portfolio is not designed to necessarily work at one particular time, but instead it works over time. It'll never be in that top box perhaps, but the good news is it'll not be on the bottom either. I think we tend to think we'd rather be right 50% of the time than dead wrong 100%. So why do we diversify? What we're trying to do is minimize the impact of volatility on your portfolio by investing in these different allocations that should react differently to changes in the market. So if you remember, I said the little white box was 60% stock and 40% bonds. So let's take stocks first of all. They tend to do better in a growing economy, which we're seeing right now. And Jelena is going to touch on that a little bit later in her presentation. While for the most part, we find bonds react more favorably and maintain better when things are slowing down. By spreading that risk out between different allocations, it allows you to ride out that up and down volatility that can be in the market and consequently maximize your returns. You're doing a balancing act between risk and reward, which John will touch on in more detail a little bit later. And again, it exposes you to more opportunities for return. It's not going to guarantee that you're not going to have losses, but it is the most important tool to try and reach your financial goals. Again, time horizon and risk tolerance are things we spend a lot of time discussing with clients because those are two key factors to consider. Time horizon may impact how aggressive you're going to invest. For example, I'm 30 years old. I'm going to retire at 67, and I'm going to invest those monies fairly aggressively because I know I have a big window before I'm going to have to touch those funds. On the other hand, I'm 30, I just got married, I'm going to buy a house in 2 years. Those funds are going to be invested much less aggressively because I'm going to need that money in a shorter window. So as your time horizon shortens, you're going to reduce your exposure to the risk. John has a great section also on risk tolerance and return, and he'll get into that in just a little bit. I'm going to steal an analogy I heard Jelena mention in a talk she was giving the other day to a group here in town, where asset allocation and diversification, she equates to driving over the George Washington Bridge and not having any guardrails on the side. So personally, I know I would prefer to be driving in the center lane. So far, we've discussed the first layer, which is why you need to have an adequate emergency fund. And then we added on diversification and asset allocation and how they help you build your portfolio. I'm now going to turn it over to John, who also functions as our resident therapist, and he's going to talk to you about the next layer, which is how to manage your emotions. John?
Meg, thank you. All this talk late in the afternoon about cake has really got me hungry. We're going to have to change our analogy around. So again, folks, thanks for taking the time this nice spring afternoon. What I wanted to cover, my first lesson here, is hopefully how to manage your emotions, or our emotions in this case. And the screenshot that you have before you is really, really interesting. So our custodian is Fidelity Investments, one of the largest investment custodians in the world, and they provide us with a wonderful set of data points. And one data point we have is what we decided to put in front of you this afternoon. It talks about what investors over age 60 did with their portfolios between February 20th of last year, when things started to go wrong, when you started to hear about the pandemic and things like that, till May 15th of that year, of last year. And during that period, what we found was about 25 to 30% of people over age 60 sold out of their portfolios entirely. So not just, hey, I'm going to take a couple of chips off the table. They sold entirely into cash. So the tendency of investors is to sell in periods of volatility. So I'm going to have to give you a little bit of math here. Jelena gave us some a little while ago. So the market last year was sort of going along kind of nicely. Mid to late February, it started to go down rather precipitously. At its trough, it was down somewhere around 35% or so. At that time, what we found was a lot of people let their emotions take hold of their portfolio, and hence they, as the chart mentions, they sold out into cash. So just to level set, we're just about the 1 year anniversary, just 2 days ago, of the lows for the year on March 23rd. The stock market, measured by the S&P 500 largest companies in America. By the way, if you're curious, this is not a hand model doing this. These are actually my hands. So that, just to, if you were wondering. So the market was down about 35% or so, which, I don't mean to minimize that. That's a tough one to take on the chin. But since then, it's up approximately 65%. A moderate or balanced portfolio that is about half in stock and half in fixed was only down about 15 to 18% peak to trough last year, and it's up about 35% in the last year. So what I'm getting at is perhaps this decision for these folks to sell into cash, in hindsight, may not have been best. What's for their best? It wasn't the best thing they could have done long term. So we talk about this quite a bit in our investment committee meetings, which we do once or twice a month. But we feel like the overwhelming reason why people sold during that period was just they had an inability to control their emotions, which is understandable considering the things that were happening last year. So I just want to spend a couple of minutes on maybe some things to the next time you or a friend or a relative might feel that way, maybe just kind of level set with them a little bit. So ways that you can control emotions when it comes to investing, and I'm not reinventing the wheel here, I'm not pretending to, but before acting or selling out of your portfolio, ask yourself, what are the reasons why I'm doing this? Am I doing it purely based on emotion? And then ask yourself, it's almost like a decision tree, so get a yes or a no and then continue. Then ask yourself, when will you actually be using this money or the fruit from this money? So Meg did a great job of talking about emergency funds. So imagine if last year you had 18 months of living expenses in cash and the market started getting volatile like it did. Perhaps a good way to look at it would be to say, excuse me, well, I have 18 months of living expenses in cash. I'm still working, or my spouse or loved one is still working, and I don't need this money for umpteenth years. That should perhaps slow your decision down a little bit. And I do this in my investment life and my personal life, is sleep on it. Don't make a rash decision. Dwight Eisenhower had a lot of famous quotes, but one of his most famous quotes was, never underestimate the value of a good night's sleep. And sometimes when you have to make a really, really tough decision, sleep on it overnight. The market will be there in the morning. And if you feel like you have to do something, do it then. But I guess my biggest take from all this is, don't rush to make a decision. All right. A couple of other things that you could do is have a written financial plan that you can go back to in times of angst and say, wow, am I on the right track or not? Update that plan quarterly. But probably the most important thing is, when you're updating the plan or looking for a financial plan, make sure your portfolio is stress tested, meaning don't let your advisor just show you things that average 8% every year in a linear fashion and it gets really, really easy. Apply what are called, without getting in the weeds, Monte Carlo simulations, which allow you to stress test the portfolio, which means even in a volatile market, Meg, you're still going to be fine when we run the simulations. So what I find is when you have a written financial plan and update it quarterly and make sure it's stress tested, the likelihood of you making an emotional decision is not as high as it was. I guess thirdly, have quarterly scheduled meetings with your advisor. So I had a meeting today with somebody via Zoom, went great. And we scheduled the next appointment for June 25th at 2 p.m. I sent out the Zoom schedule. They accepted it. So 1 quarter from now, we're going to meet again through thick and thin, good or bad. Let's meet every quarter to make sure that the plan that we have in place still fits you properly. It may seem like a little thing, but I find when I go to the dentist and they ask me to schedule the teeth cleaning right then and there, when I do it, I get my teeth cleaned more periodically, more often, than when I say, you know what, I'll call you in 6 months, I'll be good. The way to systematize things, I think really makes a lot of sense. And in between your quarterly market reviews, if you feel yourself getting emotional about your portfolio, give your advisor a call. That's what they're there for. They are on your payroll to help you understand what's going on in the market. So just as an idea, and Julina and Meg can attest to this, I mean, we were very, very busy a year ago, constantly sending out emails, white papers, our best thoughts, meeting with clients, going to clients' homes, just having conversations with them about, hey, do you have your emergency fund? Is your risk tolerance still the same as it was before? So on and so forth. So again, I don't know if I'm covering any new ground here, but when I look back at the fundamentals that have made people successful over time, they're very consistency works. Staying close to schedule works, not getting emotional works. The last thing I'll do, and then I'll jump slides, is lastly, don't try and time the market. So for argument's sake, the people that sold out on this screen might have actually been happy, because had they sold out on February 20th, the market went down another 20-25% for the next month or so. But when you try and time the market, you have to be, Jelena and I were talking about this the other day, you have to be right twice. I've got to be right getting out, and I've got to be right getting in. And studies show that over time, that's an unbelievably hard thing to do. Can I ask a question, Jelena? In this layering of the cakes for financial planning, what kind of cake is it? Is it carrot cake? Because that's my favorite. Or what do the kids say these days? My fave.
My fave. That's very popular. Whatever you want it to be, John.
Can it be carrot cake?
Sure.
Okay. I need another carrot cake like I need a hole in the head. All right, let's go on here. While you don't want to time the market, normally these slides are over a 20 and 30-year period, and I have those too as well. But this is a fabulous slide for this reason. The S&P 500 for last year. So imagine if Meg was an astronaut, which is not, knowing Meg, it's really not that hard because she's so smart. But if Meg was an astronaut and she was in space for the last year, all of 2020, and she had $100 in the S&P 500 right before she left the Earth on January 1st of last year, came back on New Year's Eve, and she had $118. So her return for her investment in the S&P, with everything that happened last year, she was up 18%. Okay, this talks to the inability to try and time the market. Had you just missed the 2 best days, there are about 220 trading days in a year, work days. So if you manage to somehow miss the best 2 out of 222, or 1% of the days, You didn't get $118 at the end of the year. Your $100 turned into $96. Now, let's assume there's somebody on this call named John who has bad luck, and he managed to miss the 5 best days. So suddenly John, instead of having $118, which Meg the astronaut had, he only has, what has he got here? He's got $83. And if John somehow managed to miss the 10 best days, his 100 didn't grow to 118, his 100 grew to 68. So that in of itself tells me that it's very, very difficult to try and time the market. Now, I'm not saying you should just be in the S&P 500, don't get me wrong. What I'm saying is you have to let the vehicles do what they're designed to do over time. But what I will also say, I'm going to jump screens here, so get ready. I'm from New Jersey, hence Jelena, do I have a little bit of an accent? Someone has mentioned that to me over the years.
Probably not as bad as mine.
I feel like other people have the people anyway. I'm told I have a New Jersey accent. I can't dispense of it. But I spent many in high school and after high school, I spent many summers down at the Jersey Shore. We would go, all my friends from Richfield Park would go and work there. And there'd be terrible storms late in the day in the summer. And your reaction at first would be, wow, tomorrow's going to be a washout because today's a washout. But sure enough, you would wake up in the morning and it was the most beautiful day of the whole summer. And it would happen fairly often. I don't know if that story works or not, but it brings me back to a nostalgic time in my life. But what I'm getting at here is often the best days in the stock market come after the worst days in the stock market. So just read this box that's in front of you. Over the last 20 years, 7 of the best 10 days occurred within 2 weeks of the worst 10 days. So if you sell out because you avoid the downturn, hey, congrats. But the problem is that the sun comes out tomorrow, and normally it can get very, very nice, the weather. Last year was a good example. The second worst day last year was March 12th. March 13th, I believe, was immediately followed it. Of course, that's easy. It was the second best day of the year. So it's hard when you start timing things. So the top of the slide talks about opportunity costs. What the definition of opportunity cost is, I gave up something in the exchange. I had the opportunity to do something else, and you have to, I'm not good with a lot of things, but like lawn equipment and woodworking, which I'll describe later, is no good for me. So I have other people do that for me. And someone might look at that and go, but you could do it yourself and save the money. But my opportunity cost is too high because I'd rather be meeting with clients and helping them with their financial planning solutions than doing a bad job mowing my lawn in Milford and trying to pretend like I'm making money by saving money doing it. So what this slide talks about is if you just had money invested and you just left it alone, your $10,000 would turn into $42,000 over time. So the key number is 10,000 grows to 42,000. If you miss the 10 best days, your 10,000 grows to 19,000. That's pretty good. If you miss the 20 best days, it goes to 11,000. So it reaches a point, it's the law of diminishing returns, where if you miss too many of the good days, you'd almost be better off just being in cash or treasuries or something along those lines. So there's a tremendous opportunity cost from missing the best days. And if you don't believe me, remember what I said when I jumped in on the call just a couple of minutes ago. The market was down 30%, but then it's been up 65% since then. So there is an opportunity cost when you try and time the market. The next lesson that we're going to go to, and again, we're layering risk. I got an emergency fund. I'm diversified. I'm going to, you know what, John, I'm going to try and control my emotions. Lesson 4 is quite critical. It's not terribly racy, but it's evaluate your risk tolerance. So what is meant by that is it's easy to be risk tolerant when the market is going good. It's easy to sit on a boat in a harbor on a calm day when it's anchored, but it's more difficult and more challenging and potentially more fun if you go out to sea with that boat. So you just want to understand your risk tolerance. So the slide's a little busy, but what it's really saying in English is this. On the horizontal axis, you have volatility, which is a measure of risk. Vertically, you have return. How much money am I going to make by entering into this agreement around my asset mix? And what's happening here is on the left, you have 100% cash. What that simply means is when you're 100% in cash, your volatility is low. It won't fluctuate that much. But what you're giving up, or the opportunity cost in that equation, is you're giving up the ability for increased return. So as you move out on, this thing is called the efficient frontier. As you move out on the efficient frontier, there's various asset mixes that work for people. So let's just say, for argument's sake, myself in my mid-50s, my risk tolerance should probably not be 100% in cash, but it probably shouldn't be 100% in stock either. It should probably be somewhere, I don't know, in this neighborhood or something along those lines. Everyone's a little bit different, but as your advisor gets to know you, just because the market's going well doesn't mean that you should be more in equities, because what inevitably happens is the market goes down and then people are like, oh my gosh, that really wasn't the risk tolerance that I was looking for there. So I'm not trying to cajole you into a certain asset mix, but what I'm saying is last year's a great example. I mentioned it before. A balanced portfolio, half in stock, half in fixed, is up about 35% off the lows of last year, and it was only down about 15% at the low. So when you start doing some of that math in your head, you're like, wow, I could have lived with that. My neighbor told me that they were 100% in stock and they didn't sleep for, the whole month of March. So it's not a thing that you're going to hear a lot about on CNBC or Bloomberg or what have you, but one of the foundations of financial planning is to understand what your risk tolerance is and then abide by it. Because if you have the wrong risk tolerance, it's like taking it's almost like taking the wrong medicine or eating the wrong diet or something like that. It just doesn't work well with the person. So evaluating your risk tolerance is quite important.
So John, you mentioned earlier how busy we were here a year ago.
Yep.
And a lot of that also had to do with us rebalancing our clients' portfolios, and rebalancing is an important piece of this risk tolerance. Can you address that real quick? Sure
thing. So thank you. What rebalancing means is this, and I'll just sort of use the 60% stock, 40% bonds as the example. So if you're 60-40, that's what's called a growth and income portfolio, you're 60-40. Last year, equities went down, stocks went up. So suddenly maybe you're at 50-50 or something along those lines. So what happens when you're 60-40 and then you go down to 50-50? Well, two things happen. What we do here is we sell out of bonds and buy stock. So I think we placed like 7,000 trades last March into equities, because we wanted to get you back to the appropriate risk tolerance or target asset mix. What it forces you to do, I want to be careful here, but it's the opposite of what the average investor does. Because what the average investor does at 60-40, if it goes down to 50-50, is they say, this thing was at 60, now it's at 50. I should get out of it and go into this thing because it hasn't gone down, or it's actually gone up a little bit. And then they get out of this and now they're 100% in the other thing, and inevitably that thing doesn't do well. That's where emotion can really take hold. So What rebalancing forces you to do, it sounds simple, but it forces you to take profits. Think about that. It forces you to take profits because your target asset mix changed, because the chemical makeup of the portfolio has changed. So there's this term we use, even Steven. You want to get back to even Steven. So if your 60-40 goes down to 50-50, you should rebalance it back to 60-40, because that's the risk tolerance that you are comfortable with. And doing that last year in March to call clients and say, hey, we're buying equities, that took a little patience and a little understanding on everybody's part. But as it turned out, it made unbelievable sense for people. Very, very, very important. It's often overlooked, or people might say, well, the stock, I'm 100% in stocks, but the stocks I own are conservative. It's sort of like, when I hear that, I'm like, wow, if I had a nickel for every time I heard that. We have the ability to X-ray your portfolio or your outside portfolio to say, hey, you can tell me that it's a conservative stock, but the reality is a stock's a stock. And if you're 100% in stock and you're approaching retirement and you don't have a pension, I don't know if that makes the most sense or not. Maybe it does for you. Maybe you're tolerant of risk enough. But if I go back several slides, the evidence is contradictory to that statement. I wanted to use the word contradictory in my presentation, and I'm going to check it off. I did it. Let's see what else we have. Lesson 5, I'm sure you've anxiously been waiting, but it's invest for the long term, okay? I've got 18 months of living expenses in cash. I've got a broadly diversified portfolio. I'm beginning to deal a little bit better with my emotions, or I'm just going to see my advisor every quarter and let them, help me through it. I'm not trying to time the market. And I think my mixture of investments coincides with how I feel about risk. Great. Jelena said this in a meeting the other day to a client. She said, I'm going to mess it up, but she said something to the effect. She said, sir, it's time, not timing. It's time, not timing. It may sound kind of simple, right? But let me ask you something. 20 years ago, it was 2001. Were you worth more or less now than you were 20 years ago? My guess is everyone on this call, most people on this call are probably worth significantly more now than they were then. And I understand inflation and all this other stuff. But the reality is that even though the markets in your portfolio can be volatile, if you allow the vehicles to do what they're designed to do over time, you make out very, very well. So in this example, at the Y2K scare, if you had 10,000 bucks, now in equities, you have 32,000, you have 3 times your money. In a 60-40 portfolio, you have about 3 times your money. In bonds, you have 2.5 times your money. And in cash, you have $14,000. None is right or wrong, depending on you, your risk tolerance, and all this other fun stuff. But I'm amazed at what people accumulate in wealth over time, because it's time, not timing. I am going to stop talking and I'm going to throw it over to Jelena. And Jelena is going to give us she is a magnificent market commentary person, and she's going to help us through what she's thinking about right now. Jelena, you ready?
I am. Thanks,
yeah?
John. No pressure.
Why would there be pressure?
I know. So we wanted to spend some time on the economy because I addressed earlier in the presentation that we had the fastest bear market that we had seen last year. We also had an equally record-breaking recovery. And so if you're listening to the media, it's hard not to. They love to constantly remind us when the markets are at all-time highs. And when that happens, we get the question a lot, well, what should I be doing with my money, right? Because what they're trying to do is they're trying to create emotion, and they try to create the emotion that gives you concern that you should be doing something else. So to answer this, we wanted to start with just the backdrop of the economy. And so if you're looking at the slide on the right-hand side, let's first discuss what makes up the US economy, or what they call GDP, or gross domestic product. And you'll notice the bar, and the bar has a bunch of different colors. But if you notice, the largest attribution is that light blue, which is consumption. So the US economy is just shy of 70% of a consumer-driven economy. And that's really important because when you go to the left-hand side, the black line or gray line is showing what happened to the economy last year. So we were growing, right? We were in an 11-year recovery coming out of the financial crisis. The markets had returned 400% during that time. And then we went into quarantine and we shut down the economy last March. And you can see that gray line just precipitously drop because we shut down 95% of a consumer-driven economy. It justifies why we went into such a quick recession. But what you'll also notice is that we've been recovering. And if you look at the V shape on the right-hand side, you'll notice that that trend is higher. However, it's not back to where it should be. And where it should be is the dotted blue line. That was the trend of the economy and how we were growing before the pandemic. And notice that we've come a good way back, but we're not all the way. And that's important because the markets are back, right? The stock market is back at its all-time high, but yet the economy is not just quite there. And I'll talk about that in a minute. But the other way to look at the economy is to maybe understand that there are cycles. And with those cycles, we have cyclicality. And so I'm going to walk through the 4 cycles. I'm going to start right smack in the middle of the page where it says late at the top. And this is phase number 1, late cycle. This is where the economy was last year, just prior to going into the pandemic. As I mentioned, we've been recovering for 11 years after the financial crisis. We were slowing down. So notice the line going down, but we were still growing. And then with the pandemic, it accelerated us into a recession, which is the second phase all the way on the right-hand side as indicated by that red U. So that's where we were during the pandemic last year. As I mentioned, we've started to make our way back. So that is phase 3, which is the early cycle all the way on the left-hand side. And what you're going to notice is there's a lot of colored bubbles. And those are the different areas around the world indicating where they are in the cycle. So really coming out of this still and probably warranting the most growth is Japan, Korea, and Mexico, all the way on the bottom left of the page. You'll notice the Eurozone is just ahead of it. Australia and Brazil and India are in orange, and then you'll see the green, which is the United States. So we're just leaving that third phase of the cycle, and we're starting to enter that fourth and final phase, which is that mid-cycle. And notice that the only area around the world that's ahead of us at this point is China, which makes logistical sense because they came out of quarantine and are technically ahead of the rest of the world right now. So,
hey, Jelena, I'm sorry.
Yes.
Help me a little bit. So a typical, I liken this to sort of, so you're saying it's like a sonic wave or something, like a radio wave, right? How long does a cycle last on average?
It's a great question. So this wave that you're looking at, they're lengthy. They last on average 8 to 10 years.
8 to 10 years.
8 to 10 years.
And the last one was how long?
I'm sorry, what was that?
The last one was how long?
Was 11 years. It was the longest expansion before we went into the pandemic. But on average, it's just shy of that. Call it 8 to 10 years.
Okay. And now we're only 1 or 2 innings into the comeback, so to speak.
Right. You can argue that. And I think it's also important to know that when you look at a recession relative to the rest of the cyclicality, it's a small piece of it.
Okay.
Right. So we could be growing for a long time to come. The expectation of growth for this year is extremely high. In fact, the Fed just increased it even higher with the 1.9 trillion stimulus that they just implemented. And at some point we'll slow down, and some are calling that for next year. So maybe we peak at that trough, but we could be in that late cycle for a very long time.
Nice.
No, thank you for asking that. And then I think it's also important to know when you think of the cyclicality and the 4 phases that I just talked about, the stock market and the economy aren't always correlated. So for example, I mentioned that the stock market is back at its all-time high, but we know the economy is still trying to get back there. However, when you think of these cyclicalities over the longer term, there are some pretty high correlations that we should be aware of. So just taking into mind the cyclicality that I mentioned on the last page, we have the 4 cycles again, starting all the way on the left, the early cycle where most of the area around the world is, the mid cycle, which is what the US is kind of starting to enter, the late cycle, which is where we were before the pandemic hit last year, and then you have your recession on the far right. So we took those 4 cycles, and what we did is we highlighted for you what the broad asset classes, meaning the stocks in green, bonds in blue, and cash in dark blue, did or tend to do during these 4 cycles going back. And so what you'll notice is that there are very high, strong correlations over the longer term within these 4 cycles. And I circled the early and mid because we believe that that is where the US and candidly the rest of the world is right now. And you'll notice that historically the stock market performs the best during the early and mid cycle. They are well above 10%, in the early cycle even higher. You get good performance from the bond market. And then as you move to the right, you'll notice that the stock market starts to slow down. And in a recession, that tends to be when the equity markets struggle. And I know that Meg did a great job talking about diversification, but this is another way of looking at diversification, because in a recession, the bond market tends to do very well. And that's the reason that you diversify between the asset classes. So I think it's interesting to note that if you believe that we are still in this early mid cycle, historically that bodes extremely well for the stock market. And we should try and, I hate to say this, ignore some of the media when they want to create this emotion that the markets are back at an all-time high.
Jelena, I was just going to jump in for a second. Maybe you could touch on like what we talk about in our investment committee meeting of how do we kind of know where we are at which part of the cycle, like you mentioned, the early to mid. What do we look at and how do we know where we are?
Yeah, it's a great question. So we have here Principal Wealth Partners and Investment Committee that all of us are on. We meet formally once a month, but we have a lot more interaction than that for sure. And I think what we try to do when we're managing our clients' portfolios is we want to think of these long-term trends, but we also realize that we can't ignore the shorter-term trends. When you talk about short-term trends, though, you also start talking about emotions. So what we look at in our committee is we start with all of the fundamentals, right? What is fiscal policy doing right now? There's a 1.9 trillion stimulus that was just implemented. What is monetary policy doing right now, right? The Fed is talking about keeping interest rates lower for longer. What does that mean? We look at the economy forecasts, right? What are the fundamentals of the economy that we think are going to drive it either higher or lower going forward? We look at the fundamentals of each asset class, right? What are corporate earnings expected to do? So it's a number of different things that we look at. We also don't ignore flows, right? How are retail investors reacting? How are institutions reacting to the markets right now? So all of that is taken into consideration in the committee meeting, if that helps.
Thank you.
Yeah, sure. So I think to quickly summarize from an economic perspective, I would say a couple of things. We know the economy is continuing to heal. It's still not back to where it should be. With that said, there is still a tremendous amount of opportunity in the markets for return going forward. However, there is a caveat, right? The caveat is that the markets don't go in a straight line. And we know that. And when we don't have that straight line, that is the reason we have the fundamentals to help us keep us in the portfolio. So with that, I'm going to hand it back to John to conclude. And I want to say thank you as well.
Jelena, thank you. That was awesome. So folks, I want to thank you for taking the time this late afternoon. Meg, do we have time for one more story?
Of course.
So a great name, but it is actually a true story. I have an uncle, and unfortunately he's no longer with us. He's deceased, but Uncle Larry was a a State University of New York college professor, and he lived in Oneonta, New York. And I would visit him quite often. He was a bit of a mentor to me over time. In his garage, he had a wonderful workshop where he created these magnificent things with wood. He created the bassinet that my three daughters slept in when they were born. They were born at different times, so it worked out well. And I'm waiting for the day when I can give that as an heirloom, or whatever that term is, to one of my daughters, and their child can sleep in it as well. But he wouldn't let me near the machines or anything because there was an accident one summer, but I'll discuss that one time in person with you guys. But I would watch him create things. He would just take a piece of wood, and then sure enough, over time, like, it would turn into this other thing. And I would ask him about it. And he would try to sort of mentor me, like I just mentioned, but he'd say things like, he never worked on wood without a blueprint. He said, I'm not going to do it without a blueprint. So for the first thing I got to do is figure out what I'm trying to accomplish, create a blueprint, and then I go to town, so to speak. And he also said, John, you got to measure twice and cut once, because wood can get expensive at times. And if you cut it the wrong way and it becomes a piece of junk wood or a piece of firewood, that can prove quite costly over time. So where am I going with this? The blueprint for everyone on this call is your financial plan. So you should have a financial plan. If you don't, quite frankly, you should get one. A service that we offer here is for friends and relatives and acquaintances and neighbors. If they have a financial plan or don't have a financial plan, and they want one of us to act as a sounding board, just to say, hey, here's some things that you might want to consider doing. You might want to consider getting your risk tolerance in order, or be diversified, or something like that. We'll be happy to do that. We really enjoy, I hope it comes through via Zoom, but we enjoy helping people and working with people, and we appreciate all of you. So if you know of anybody who might need a blueprint, we'll be happy to provide that. But first and foremost, I want to thank you for attending, and you guys are awesome, and we will talk down the road. Thank you.